Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about how the size of the return is less important than the length of the return. So obviously investing well is important. However, investing well over long periods of time is the most important thing. Very simple concept, but which I will explain and elaborate on, of course, but something that is fundamental, I think, to reminding ourselves of, particularly during times of, I guess, higher levels of uncertainty. When there's higher levels of uncertainty, the future looks a little bit cloudy. You know, people don't know which direction the economy will go and so forth. And obviously I'm referring to COVID here and the uncertainty created by COVID. And so in times of very high uncertainty, what we must do is return to the fundamentals, because the fundamentals rarely change, or in fact don't change, and the fundamentals are typically underpinned by simple math, and math does not lie to you. So look, everyone would agree, for example, making a one-time 50% return on an investment is a wonderful outcome. I invest in a stock for $10 and I sell it at $15, happy days, that's a good outcome. But making a much smaller return over a longer period of time is far more effective. So for example, if I generate a 7% return for 40 years on average over a 40-year period, that's going to multiply my initial investment by 15 times. So rather than the one-off investment increases my investment by 50%, 15 times. So that's really the key component. And in the show notes and obviously the blog on the website, I have a link to a chart that Vanguard updates every year. And it's an index chart that looks at, if you invested $10,000 in 1990, what would it be worth today? And in that chart, $10,000 invested in 1990, if you had to put that in the Australian share market, you'd have $130,000, so 13 times the investment. And if you put it into US shares, you'd have nearly 19 times the investment at $190,000. Pretty considerable wealth off a relatively small investment of $10,000. And I guess the point I'm trying to make in this podcast, and I will make throughout this podcast as something to sort of remind you of, is that ask yourself, why do most people fail to generate such substantial returns over any period of time, say a 30-year period of time? And the reason is that they are always influenced by short-term noise and don't stick to the long game. Don't play that long game. Don't take that long road to building wealth. And what you really need to do is have the discipline to stick to that long-term approach and not get distracted by things like tech bubbles, and that's in the early 2000s, or the GFC or coronavirus. All these things seem like at the time they're going to change the world forever, but they rarely do. And sticking to that long, well-trodden path of investing in quality assets is an important thing to do. Let me give you another example. The ASX index is trading at just under 6,000 points at the moment. That's the ASX 200, plus or minus, obviously, depending on when you're listening to this podcast. But if it grows at 2%, what do you think the index's value will be in 50 years' time? So 6,000 today, if it grows at 2%, it'll be 16,100. That's what the index will be. Whereas if it grows by 4%, it'll be 42,500. But if it grows at 8%, it will be 280,000. Right? 6,000 today. Now, 8% still less than the 8.9% growth it's provided over the last 30 years. So it's a very simple example, and I get that it's not overly relevant or applicable to most people because, they don't necessarily want to invest today and have to wait 50 years to enjoy the proceeds. But the point is, it's a beautiful example that illustrates the benefits of playing the long game and being focused on that. Now, I'm usually very skeptical when people tell me things have changed forever. Like I said previously, the world is full of forecasts, and forecasts, particularly negative ones, sell clicks, sell newspapers, attract attention, and attention creates a lot of money for media. So it makes sense that the more extreme your forecast, the more attention you're going to attract. And at the moment, for example, let me use work from home, because at the moment, a lot of the workforce is being forced into this work from home situation because of COVID, and a lot of forecasters are telling us that companies are going to desert commercial office space en masse. And that the increased work from home will permanently increase demand for regional property, and as a result, reduce the demand for property that's closer to the CBD. And as Warren Buffett says, forecasters will fill your ears but never your pockets. And I think you should maintain a very healthy level of skepticism when anyone tells you things have changed permanently overnight, because they very, very rarely do. So let me just focus on this work from home topic, because I think it's a really good example. So it's my view that working from home will have an impact on demand for commercial office space, and to a much lesser extent, demand for residential property in rural locations, or regional locations, I should say. But the size of the impact has been grossly overstated. So you look, the forced increase in work from home has certainly changed its acceptance, and I think that's probably the biggest outcome, rather than necessarily changed its adoption. So I suspect in the past that most people, particularly people that weren't working from home, viewed the people that did work from home as kind of an opportunity to hide or to reduce their workload or to avoid any tasks, have a bit of a slow day, those sorts of things. However, now everyone has been forced into, or most of us have been forced into this work from home situation. Most of us now know that actually you work just as hard, if not harder, because there's fewer distractions. And another thing also is that a few CEOs have told me that they used to feel obligated to go into the office every day, to be kind of seen, to be there, to be available, and so forth. But that expectation of themselves and of their team members has now changed. So I think that's the biggest outcome from this COVID situation and in the enforced work from home, is that it's going to increase its acceptance, and people will be more willing to utilise that flexibility on a part-time basis when it sort of suits their needs. And just because you can permanently work from home for 6 months doesn't mean you're going to be able to do it for 6 years. And I think the reality is that few industries, employers and employees is suited to permanent work from home, because the big element of sort of that employers want to create and that employees want to participate in is collaboration and human contact and conversations and relationships and those sorts of things. And it's not impossible to do them remotely or maintain them remotely, but not over really long periods of time. I think I'm less likely. So I think that's the outcome, is that people will now probably more mix their working arrangements, maybe a few days at home and the rest of the time in the office. But, the office is certainly not dead, and neither is working from home. So how do you apply then the ideals of playing that long game, shooting for long-term returns to property shares and cash flow? And that's what I wanted to do is take this concept and now apply it to obviously investing in real terms. So if we talk about property first, how do you persistently achieve a capital growth rate of, say, 5% above inflation? And I think that's probably a reasonable level of return to target. And obviously, if inflation's lower, then you're only adding 1% to that 5%, so you're looking for 6% capital growth. Historically, the inflation rate in Australia has been closer to 2.5%. Which means a headline growth rate of 7.5%, including inflation. I think that would be I think that'd be kind of the floor rate that you would expect over long periods of time if you're investing in investment grade property. And to achieve that, really what you need to do is invest in a location that has very robust fundamentals. And these fundamentals will ensure that demand consistently exceeds supply over long periods of time. Let me underline that, over long periods of time. And that translates naturally to capital growth, to price growth. The thing to note is really the concentration, which I've spoken about before, but the concentration of Australia's population and our population growth. Our population growth is 2.5 to 3 times faster than the UK and the US, for example. And that means that puts pressure on housing. We need to build houses for all these people. And sure, you can argue, hey, Stuart, COVID, there's no overseas migration anymore. But it'll come back online and probably enjoy stronger demand than it ever has because Australia really has done an incredibly great job at managing the economy and managing the virus as well. The other thing we need to be really cognizant of is that in developed economies around the world, the income and wealth inequality is getting worse. So that is, the rich are getting richer and the poor are getting poorer. And it's really something that's a trend that's been present really since the 1970s or even arguably before. And we can argue, whether it's fair, and certainly I would say that it's unfair. That people don't have equal opportunities in terms of wealth and living standards and those sorts of things. And of course, it's my view that government should implement bipartisan policies to improve this inequality. However, in reality, I don't see it happening. If there are some policies, I don't think they're going to be that effectual. And capitalism seems to be pretty much an unstoppable force. If you look at the ABS figures, the wealthiest 20% of Australians own 63% of private wealth, whereas the lowest 20% own a mere 1% of private wealth. So this concentration of wealth, and then together with this long-term trend of much higher population growth, means that there is a significant cohort of people that are willing and able to pay more for property in blue chip locations. And so sometimes economists and investors kind of extrapolate, well, if Melbourne keeps growing at this rate, property it can't keep growing at, say, 8% per annum median house price across the board, and it can't. It absolutely cannot mathematically. But I guess the error there in extrapolating those figures is to just looking at median house price. What you really want to be asking yourself is, can investment grade property continue to grow at that rate? And because of stronger population growth and greater concentration of wealth in fewer people in terms of population, there's always going to be a really strong cohort, at least for the next number of decades, of people willing to pay more to get into Hawthorn in Melbourne, for example, because of all the amenities, school zones, those sorts of things. And that's a really considerable, I guess, wave of demand that is certainly observable. And unless you think capitalism is dead, is never going to repeat itself, is going to change materially, then just the simple laws of supply and demand will dictate that if you really want that persistently long level of capital growth, then really what you should be doing with property is finding those areas that are in massively high demand but very, very finite supply, and invest in those. And what I tried to do is actually find out, for example, put some numbers around it, how many properties are in these investment grade locations compared to the overall population. And I couldn't find the numbers, but I would hesitate to guess that we're talking about less than 5% of property, and we're talking about the top 20% of the population that are going to have the capacity be able to pay more for that property. And therein lies the imbalance of supply and demand. And that's why I think, yes, at a median price level, something has to give. Properties out, 30 Ks from the city shouldn't be selling at $1 million plus. That's where my unease with the property market rests. But if we're paying $3 million for a family home in Hawthorn, or 2.5, that seems like good value if we take that long-term approach. So how do we apply this long game theory then to investing in the share market? And let me refer to an often cited bit of darling or stellar stock in the Australian stock market, Afterpay. If you're not familiar with it, Google it. I mean, there's been a lot written about it. Afterpay share price in March was about $9. A few weeks ago, it got up to $90, so kind of a tenfold return. It's back to low 70s now. Obviously, been a little bit more volatility this week. So, if you invested in Afterpay in March, you've made a pretty sizable return, somewhere between 7 and 10 times your return, depending on if or when you sold. However, there's a few problems with Afterpay. Firstly, if you invest in Afterpay, your success of doing so is whether you get the decision right when to sell. If you hold on too long, you could have no returns, whereas you sell arguably early, you could pick up lots of the returns. And so, as Kenny Rogers said, you've got to know when to hold them, know when to fold them. That's very much the centre of that strategy if you're going to invest in stocks like Afterpay. And the reason is because it's never going to provide long-term returns. It doesn't make any money. The more it grows, the more capital it needs because it's lending money to people to want to purchase things that they don't really need. It's burning through cash for that reason. It will almost certainly attract more government regulation. And there's more and more competition, and without a doubt, buying at this price, $70 or $90, you are buying a massively overinflated stock. So it's never going to be a long-term play. But let's say you get it right, what do you do next? And that's the problem. You've got to consistently pick the next Afterpay, and also get your timing right in when to invest and divest of that stock. Alternatively, you could adopt an investment methodology that avoids the risk of picking the wrong stocks, the wrong sectors, and the wrong investment managers. And I've spoken ad nauseum about the benefits of a low-risk investment methodology such as rules-based, index-based approaches. And obviously there's a lot more podcasts and I've written books and so forth on that factor. And then if you refer back to that Vanguard chart, obviously Vanguard index fund provider, I think it illustrates the benefit of taking that disciplined, broad-based, very diversified, low-cost approach, but long-term approach to investing in shares. And let's apply it then to cash flow. So the difference between, say, saving $100,000 every 10 years or $10,000 consistently each year is substantial. And so playing that long game and consistently saving a reasonable but conservative amount each year and contributing that towards an investment strategy is incredibly powerful. The ability to predictably and reliably contribute that regular amount allows you then to spread your timing risk, invest in markets over time, adopt a gearing strategy and those sorts of things. And I've spoken before previously, and there's a link in the show notes of a video or webinar I did more recently where I talk about how do you get control over your cash flow without needing to sort of manage every dollar and cent, but still have a good process. So I've got that in the show notes, a link to that in the show notes and so forth. So there you go. That's what I wanted to talk about today, which is really it's the length of the return rather than the size that matters. And that's just a mathematical fact. And so therefore you must absolutely stick to an approach, adopt and stick to an approach that in my view is evidence-based, that demonstrates that if I'm going to invest in this way for 30 years, if I'm going to adopt and hold on to this and persist with this investment strategy, you certainly want to know that you're not wasting 30 years by doing so. And so therefore, employing those rules-based approaches, and but most importantly, ignoring all the short-term news is absolutely critical to building wealth. Easily said than done. And the evidence is there because a lot of people, the vast majority of people, don't nearly achieve or successfully build as much wealth as they possibly could, and the reason for that is they're too reactive to all that short-term noise, and they don't adopt a fundamentally sound investment methodology and play that long game. Okay, a bit of a longer one this week, so apologies for that, and until next week, bye for now.